Hello, everyone, and welcome to Buck Stops here. I'm Catherine Murray. Well, as we know, the markets have been very volatile on a year-to-date basis. It seems though we've got a little bit of strength this week, but as you know, I do film this on Friday. We have, of course, the jobs numbers in the United States, was a huge blowout number, disappointing in Canada. But what's interesting about the jobs numbers in the United States, the market from a futures perspective started to sell off. It's almost as though great news is not being well received. So what do you do in this marketplace? It is very difficult for a lot of veterans in the market, very senior portfolio managers, people who've really been around. So I wanted to bring you one of those types of guests today. And for that, Thomas George is joining us. He's the portfolio manager of the ETF GRZZ, GRZZ. He joins us now, and welcome. But also, Thomas, you've been on the street. You were a very senior analyst at one of the big banks before becoming this portfolio manager. So you've got some great perspective here to share. But what are your thoughts these days?
Yeah, well, Catherine, always a pleasure. And yeah, so at TD, that's my previous role. I was running resources, from the resource funds, and we were also doing sustainability. I helped start the whole sustainability franchise. So just seeing where we stand today, it's incredible. It's an incredible world where 10 years ago we were just starting to nibble at what ESG meant. And now it's just almost like, in a lot of ways, from an institutional investor perspective, it's almost a guiding light in a lot of ways, right? This is double black diamond skiing for sure. This is an incredibly volatile. I've always been focused on growth investing. It's never been easy terrain because the value guys are easy. I just set it, forget it. This is a cigarette, but I'm sure it'll turn into a half cigarette one day, and we'll be great. For growth investors, you just can't. You have to stay nimble. You have to not be focused on a mantra. You can't be a fundamentalist. You really have to just stay nimble, and that I think is an incredible place to be if you're an active portfolio manager. Not so incredible if you're buying an index, and I think that's something I'll talk more about, but that is something very important feature of the market that we think has changed.
Right, to be active, not passive. I think, though, people who believe in the Warren Buffett way of investing would disagree with you in terms of being a fundamentalist, no?
Well, so the way we think about it is where we sit right now. To the fundamentalist view is always like, hey, listen, I can sit on this portfolio of companies that were great 20 years ago. That'll be great 20 years from now. I just don't think that is not a wise outlook, right? It's technology is here. It's here to stay, and it's here to disrupt, right? And that's where we think the Warren Buffett, if the traditionalists, I'm not saying value doesn't matter. We are growth focused on value, but traditionalists have a problem in the sense that they're anti-technology, right? They just can't simply get their heads around how things move so quickly, and that's where they'll stumble.
Got it. And we are going to delve into some of the areas that you're really focused in on. But before we get to that, I mean, the fact that you described the market as a double black diamond, why?
Yeah, so it really is. The current environment for the high level. It's inflation, right? And when we have a generation of investors, right? Everyone that I know, the veterans. Clearly the young people that have driven the GameStop madness, all of us collectively have no idea what inflation is, right? And that is it's uncharted territory. And by definition, uncharted territory, especially inflation, just looking back a little bit, it doesn't make for a great mix in terms of managing funds for set it and forget it, right? And I'm going to talk specifically around the whole index fund mantra, right? And I think it's not a coincidence that we've seen a period of low rates, low inflation, where index funds, passive investment strategies, like call it buying the S&P 500, set and forget, and buy the dip. I think that is going to be challenged continually.
Right. It's interesting, though, just with respect to inflation, because inflation has kind of changed the rules of the game that nobody's been used to playing for decades.
Yes.
But one of the reasons why the market's actually moved up over the past couple of days, or even found some stability, is because of the view that perhaps we've seen peak inflation and peak Fed speak. We're going to take a quick break. We'll be right back. So Thomas, I was just saying that there might be the view that we're seeing peak inflation. I mean, I think anybody listening to this is saying, no, that's not true. My gas bills are still high, and food inflation is here and probably not going away. So, but the market's kind of anticipating that there might even be a Fed rate cut in 2023. So, let's just get that on the conversation before we move into the areas that you focus.
Yeah, and there's no question that we're going to see elements of inflation roll over, right? Rising by the Fed increasing interest rates, they are going to slow down the economy. There's no question about that. We've seen lumber prices come off. We're starting to see oil prices fall, but we fundamentally believe, big picture here, that energy, the vector of energy specifically, is one where inflation will remain sticky, right? And that's where investors, institutional investors, retail investors have been structurally underweight, right? And so that's where we see the opportunity, where if you just take this approach that, you need to insulate your portfolio, but you also need to provide your portfolio the upside. That's what we call the barbell strategy. And that's what we're employing in the GRZZ portfolio, where we say, let's own energy because there's been a multi-decade underinvestment. And right now you have a ongoing war between Russia and Ukraine that is that's causing a lot of fundamental energy issues for the European Union, specifically Germany. We think that is going to create a dynamic where, while you'll see other aspects of inflation roll over, this one, which is obviously a very important one for most people, heating homes, electricity, filling your car up, that dynamic we believe is going to be far more sticky. And I'll give you an interesting tidbit, right? So the shale revolution, the whole, everything that happened in last decade, all of the dynamic of finding shale in the US, that produced zero free cash flow. Zero. Incredible. Like, you had an incredible revolution happen and it produced no free cash flow. Yeah, how'd that happen? So the only free cash flow that they've produced, and it's been a juggernaut, has been in the last 2 years. And that really has been basically because of A, COVID, and B, the fact that supply has been so constrained. So you think about this dynamic, it's incredible, right? Where you actually have an industry that hasn't made a lot of money historically finally start to make a ton of money. And the other side is they're not putting capex in the ground, and that that to us is a very positive sign on that front.
Right. In other words, don't expect any additional supply to come on. Because they're not putting money to work in it. So many of the energy companies have been vilified to a degree on so many fronts, and one of them is, to your point, the lack of free cash flow, and therefore they're not going to do it. And there's so many governments and boards that even are continuing to pressure them to not do it. So, in other words, we're going to have supply constrained for perhaps a little bit longer.
Exactly. And for us, we're very overweight gas and natural gas. So one of our plays is that we think this structural dynamic in Europe, they're going to have to fix that, right? And that we think it requires a Manhattan type project in LNG. Right. So this is like, if we had to really, if I could be totally frank here, this should not have come at a surprise to Europe. You're sleeping with the enemy, right? You're going tisk, tisk, tisk to Russia. Meanwhile, you're taking your entire energy source from Russia. Where's the surprise here? And there's there should have been a council saying, hey, we need to address this. Who knows what Putin's going to do and when. But no, let's wait for a catastrophe and let's ask everyone to wear an extra sweater, turn down the air conditioning, whatever it is. I don't know, whatever. Bottom line is, you're talking about fundamental needs for humanity. Energy is it. Like that's like, energy and food. That's what you need to survive. And you don't have a contingency plan. Europe is just, in terms of like dodo brain, you just went from like being like a world-class economy to being like some banana republic that didn't turn on the other generator. Like, who does that? But that's Europe right now. And the dynamic for investors, obviously, and this is why active investing is so important, that's the opportunity. You're going to have to require a significant amount of investment to deliver energy to this dodo bird economy that didn't say, hey, we need a contingency plan here. What if Putin goes crazy? You've been calling him nuts for a decade.
All right, we're going to take a quick break, and we're going to get the stock when we come back. So, Thomas, if nat gas energy is a real focus point for your ETF, GRZZ, and it's a barbell approach, you want energy and then you want growth stocks.
Yes.
On the energy front, which stock would you want to participate in?
So we've got several that we play. I think natural gas. EQT is the name we like. It's the largest producer. Marcellus, Great Rocks. These guys are just churning out free cash flow. That's a clean story we like, and it's in America. Very important. We just had the UN, director general. He's like, hey, listen, tax these guys. I'm like, no. I want to be in the most capitalist place right now where my stuff is protected. I'm not going to go, I'm definitely not owning, whatever in Europe right now. Europe is a mess, right? So just, you want to own it in the bastion of capitalism in America. Also, secondarily, what we like is electric metals. We think that will continue, right? So we think copper, lithium. So on the copper side, we like, we think the small mid-cap space is incredibly cheap. We like Sierra Metals. And then on the lithium side, we like SQM, which is an incredible value play on the lithium side. And then also we believe with all the additional renewables that have been added to the grid, we haven't added real grid stability. So we need grid level battery storage. So we think vanadium redox flow batteries are the clear winner there. And the name there is Largo. So we think that group of stocks there is very interesting. And for those who are, more conservative, we think one of the best risk reward plays, it's a top holding in our ETF as well, is NextEra Energy. They're a utility based in Florida, fastest growing utility in America because it's Florida. There's ton of economic activity there. And also, they've also been a leader in renewables. So combination of continuing to put in renewables, continued growth within the state and electricity usage within the state. And what you get there is when you buy a growth utility, as you were saying, Catherine, as the market, if the market's starting to price in rate cuts, that's a good thing. That'll be a good thing for utilities. And so what we're saying is there's a nice balance there because you get the growth aspect and also you get the protection.
It's interesting when I was looking at the market yesterday, I think it was yesterday, the utilities were continuing to be an outperformer, and they have been an outperformer. I'm not entirely sure why, but, in the sense that the valuations, and again, I felt like I missed that trade big time. And the valuations, to me, when I did look at it, were way out of whack versus what a utility would normally trade at.
Yeah, and so I would agree with you for actually most of the market there, with the exception of NextEra, right? So most utilities are not growing. NextEra is growing 14% year on year. That's a significantly high growing utility, right? So we would say yes. For most utilities, you could think of them just like a bond, right? Like based in Alabama, whatever. Name a state that's doing nothing. Name a province that's doing nothing. They have exposure to that, right? Like in general, right? But for some utilities that have torque and growth, we like them, right? And for NextEra, based in Florida, they're putting on a ton of renewables, so they're going to be the first ones to put on battery storage. All of these things that require capex in the ground, they're going to put in vanadium redox flow batteries or any other type of batteries. We think that whenever you're the leader, you're the one that's going to be putting capital in the ground, and that increases your rate base, which is what you charge your users. And it doesn't hurt that that the new Silicon Valley is in Miami as well. So all of that plays to the story there. But again, it's very specific. So I would 100% agree with you. For the most part, utilities are like bond proxies, like and kind of poor ones at that. But versus a growth, high cash flow yielding utility like a NextEra.
Got it. And just to be clear, what's the ticker on it for everybody to know?
Yeah, so the ticker on NextEra is NEE. And I'll give you all the tickers. So the ticker on Sierra Metals is SMTS in New York, SMT in Canada, and then for SQM, that's SQM in New York, and then Largo is LGO, both in the TSX and the New York Stock Exchange. And EQT,
okay, so great.
And sorry, EQT is EQT.
Right.
In the New York Stock Exchange.
Yeah. So that's good. So for some Canadian viewers, you've got two that trade both in Canada and the United States, LGO and SMT. Yeah. Correct? Okay,
correct.
Good. What's that?
Yeah, no, those are the ones, and we think there's still a huge, like right now we think the small mid cap space in mining particularly is where we see a ton of value, right? It's where we think.
So Thomas, you were saying that you think there's a lot of opportunity, a lot of value in some of the small mid cap areas of the market. That can be pretty dangerous in a very volatile market too.
Yeah, for sure. So what we're saying specifically is the small mid cap space in mining, right? And our preference is for base metals, particularly ones that have a tilt towards electrification. We just think that for the same reasons that capex hasn't been put in the ground for the oil and gas sector, same exists for mining, right? And one dynamic that's happened in both sectors, right? Both sectors have outsourced. Have stopped exploring the large cap names, right? The large cap miners, large cap oil and gas companies, they don't find things anymore. They buy things, right? And so we think in that dynamic, when inventory has been driven down, and when the valuation differential is significant, and there is a large differential between the large cap mining stocks versus the small mid, we think that's where the opportunity occurs, and that's across the spectrum. So we think that you're seeing that in every aspect of the mining sector. So be it uranium, there's a ton of value in the small mid. Obviously, as you said, it doesn't. So we manage it like we have obviously in our ETF. We're taking we take risk managed positions. So it's these aren't going to be the top two holdings or whatever. But that's where the upside is, and that's you have to manage your position size. Can't emphasize that enough. Portfolio could. This is the era. This is the this year, next year. Those that win are not the ones like, oh, I got that good stock. Well, how much did you know what I mean? It's how much you owned in your portfolio construction, right? And that's something that I think a lot of people who maybe owned 100% of their portfolio in Bitcoin are finding out what portfolio construction is about.
So Thomas, I want to get your take on tech. That's the other area of the market that you think that there's quite a bit of opportunity in, and it's been really volatile. So how are you looking at it these days?
Yeah, so that's the other side of the barbell. We talked about the energy side, and that's going to protect you against inflation. And then the other side is, well, what if the world's good? Well, hey, listen, and that's where the growth, where we believe you're getting now tech on a discount, right? Because what happens is when rates rise, particularly stocks that were baking in a lot of growth their multiples come off the fastest, right? And that's what we've seen. We've seen a significant pullback in valuations across the tech space. We particularly like the large cap tech space because they got a ton of money, important. We don't know how long this will last, right? And so we want to make sure we're insulated, right? And so by going large cap, you protect yourself there. These companies are still leaders, right? Like when I think of a Google, you have a you have a company that has the crown jewels of the internet. I don't think there's a day, maybe an hour, maybe 5 minutes where I'm not Googling something, right? There's some, it's
Right.
become part of you, right? And YouTube has, it's turned everything on its head in terms of content creation. It's literally, you have focused channels. It's so dynamic, and I think we're still scratching the surface for all of what Google can do. And then, I mean, we like Visa, MasterCard. Now, some last year would have said this was less sexy, but what do you know now? Maybe you're just spending like maybe the best digital rails are the ones that we always knew.
Right.
And right. It's not to say that, that Ethereum, Bitcoin don't have its day in the sun, but bottom line is, digital transactions it's still going to continue, and wherever the world goes, Visa, MasterCard are going to be there, right? And they're going to be bedrocks there. And lastly, I have to talk about Facebook. It's probably the stock that causes us, it's one of the most interesting stocks. It's off more than 50% this year.
Yeah.
And and Zuck, the traditional thing was you never bet against Zuckerberg, right? Like he's
You buy Facebook here? Down 50%,
yeah.
you buy it?
So we own it now. I'm not saying it's without warts. That's, this is the value side of, we do take a valuation lens on what we do. And I'm not saying we don't like where he's going with metaverse. I don't. But I think that he has enough levers here that and the free cash flow that he will generate, that it gets interesting, and the valuation makes sense. I
gotta leave it there. Thank you so much. We'll speak to you soon. And thanks everybody for watching. Great to have you.
Thank you.